One of the most profitable ways of investing in the modern era has involved having a list of financial conditions every company must meet in order to be considered a buy. As a portfolio manager, I use this method myself to select stocks for my clients, and I didn't see this level of success before I added this to my stock picking method. For my very first podcast, I want to give you 5 key stock picking gems. Look for these things when adding stocks to your portfolio, and you will instantly be less concerned about losses. The first thing I look for in a stock is reasonable valuations. For example, price to earnings, price to book, price to sale. The more reasonable the valuations, the more reasonable the expectations. It's not just about finding a cheap stock, it's about finding a great stock minus the hype. And it's not enough to say the company has a low price to earnings or price to sales I'm going to buy. One rule of thumb is to compare that company's valuations to the S&P 500 as well as the sector or industry. If the company has valuations greater than the S&P 500, growth investors love that. This means people are willing to pay more to own this company. But what if the company has poor finances, or even worse, assumptions about the company's growth are just way off? Stocks with high valuations can be beaten down when they don't live up to expectations. Investors looking for high growth should be sure to double check the company's finances. At a minimum, the company's free cash flow and retained earnings should be in the positive, and they should have a history of being profitable. Now, for value investors, you are looking for lower valuations, but the key to it is you're looking for low valuations on stable, profitable, and high free cash flow brands that can continue to generate returns for a long period of time. The second thing you should be looking for is diversity. The current company you're looking at should be making your portfolio more diverse. It should be in a sector that decreases your overall market risk, or at the very minimum, it should be in a different industry. Long story short, the company should be earning revenue from somewhere else. This helps to balance out your portfolio and give you more protection when the economy goes into different cycles. Here's an example. When oil prices are high, the airline industry suffers and the energy sector performs well. If you already owned stock in an airline company, a great hedge against that investment would be to own an oil company as well. Diversity also helps to protect you at times when there's a lot of fear in the market. Most investors highly favor the tech sector, but when the market gets spooked, the tech sector is usually one of the worst performing. If you have a lot of tech in your portfolio, you may want to diversify by adding some defensive names. Defensive sectors include consumer staples, healthcare, and utilities. All in all, as you add stocks to your portfolio, you want to be keeping a healthy balance across sectors and industries. This reduces your risk, minimizes your downside, and ensures you're not depending on any one sector to generate all of your returns. Number 3 is the company's ability to handle their debt. This is known as solvency. We can measure this through the quick ratio, current ratio, and the debt to equity ratio. But this can also be looked at from the operating cash flow ratio. The quick ratio is one of the most important. It lets you know how much of a company's current liabilities are covered by cash and cash equivalents. Any number greater than 1 is fantastic. The greater the number, the healthier the business. As for the current ratio, it lets you know how well current liabilities are covered overall. Current assets are either cash or assets that should be converted into cash within the next year, like inventory. Current liabilities should be paid within the next year. I prefer this number to be 1.5 or greater, but even companies like Apple can fall short at times. The debt to equity ratio lets you know how a company is financing their operations. The higher the debt to equity ratio, the more the company has relied on debt. The lower the debt to equity ratio, the more the company has financed its operations internally. A debt to equity ratio below 2 is usually preferred by risk averse investors. The operating cash flow ratio is a measure of solvency that isn't talked about a lot. In fact, it's not talked about enough. It's actually one of my favorites. You take a company's operating cash flows and divide it by the current liabilities. The greater the number you see as a result lets you know how many times over the company can finance their liabilities. I like to see this number matched with the quick assets to determine how well a company's current liabilities are actually covered. High free cash flow yield comes in at number 4. This is the same as saying low price to free cash flow. We all know how important free cash flow is. You may hear your favorite investor talking about it all the time, but what's very rarely talked about is how to interpret the cash flow of a company. Studies have shown that companies with higher free cash flow yields tend to have better performing stocks. In fact, they tend to outperform companies with low price to sales, price to book, and lower price to earnings historically. Of course, we should look at the entire company before buying the stock, but I never buy a stock without considering the free cash flow yield. Last, but certainly not least, comes the gross margin at number 5. The higher the gross margin, the easier it is for a company to handle their other expenses, including their debt. Also, it's a sign that the company has low cost to produce their product. When compared to companies in the same sector, high gross margin can also mean better efficiency. Some investors look at this as a key competitive advantage. I've always called gross margin the first line of profit. The higher the gross margin, the more money can hit the bottom line. It's important to compare the gross margin of a business to similar companies. It's also important to decide what's too low for you to accept. I don't invest in companies with gross margins lower than 15%. As an investor, I'm just not interested in low grossing products, services, or brands. Look for these 5 things when picking your next stock to improve your portfolio returns. We have more great podcasts on the way, but if you want more great tips in the meantime, be sure to follow the social media links in the description. I'll be doing live follow-ups on the Clubhouse app, giving listeners a chance to ask questions and suggest topics we can cover. Thanks for listening to today's episode. I'm your host, Ron Forbes, the stock market analyst they didn't want you to know.